Tonight at 8 o'clock Eastern Time, a deadline expires that every person with money in this country needs to understand right now. On Sunday, President Trump posted a message on his Truth Social account telling Iran to open the Strait of Hormuz or be, and this is a direct quote, living in hell. He gave them until 8 p.m. Eastern on Tuesday. That deadline is tonight. Iran's foreign ministry spokesperson responded this morning. He rejected the temporary ceasefire proposal drafted by Egypt, Pakistan, and Turkey. He rejected the 45-day pause. And Iran's president's spokesperson called Trump's ultimatum sheer desperation and anger. As you watch this video, the Strait of Hormuz remains closed. This is not a foreign policy story. Not for the purposes of this channel. This is a financial story. And it connects directly to a set of numbers that every person who earns a paycheck, owns a savings account, or pays for gasoline needs to understand before Monday's market open. This morning, the Bureau of Labor Statistics released the March jobs report. The headline was 178,000 jobs added. That sounds fine. That was triple what economists expected. Here is what was buried in footnote form at the bottom of the release. February's job loss was quietly revised downward, from minus 92,000 jobs to minus 133,000 jobs. That is 41,000 more jobs destroyed than they initially told you. And the 2 months combined, January and February, are 7,000 lower than previously reported. 16 of the last 19 Bureau of Labor Statistics job reports have been revised downward after release. 16 out of 19. Moody's analytics chief economist Mark Zandi flagged this directly this week. He said that if anything, these downward revisions suggest the job market is even weaker and recession risks are even higher than the current data shows. Moody's artificial intelligence recession model sat at 49% before this week's data hit. 1 percentage point below the threshold that has never been crossed without a recession following within 6 to 12 months. That model is back-tested across 80 years of economic data. The last time it sat this close outside of an actual recession was September of 2007. You know what came next. And every input that feeds that model moved in the wrong direction this week. Which means by the time you are watching this video, the true reading is almost certainly above 49%. If you have money in a retirement account, a savings account, or simply pay for groceries and gasoline, what I am about to walk you through is the most important financial briefing you will hear this month. Because on the map that has predicted every major collapse for the last 100 years, there is a label for exactly where we are right now. Every major financial collapse in modern history has followed the same 4-stage sequence. The names of the countries change. The decade changes. The mechanism does not. Stage 1 is the compression phase. Central banks pump the system full of money. Asset prices rise. Banks lever up. Risk-taking becomes normalized. Then the central bank pulls liquidity back out. Slowly at first. Then faster. The official reason is always inflation control. The real consequence is always reserve depletion. This is where warning signals exist but get explained away as isolated and already contained. This is where you hear the phrase, "this time is different," most frequently. Stage 2 is the expansion and overextension phase. New financial instruments appear that promise returns without the traditional risks. Retail money arrives late, after institutional money has already positioned. The leverage that built in Stage 1 becomes load-bearing. Officials step in front of cameras and deliver confident statements about the resilience of the system, the adequacy of the buffers, the strength of the fundamentals. The more precise and confident the official reassurance, the more urgent the problem beneath it. That is not a theory. That is the pattern from every crisis in the historical record. Stage 3 is when the crack appears. Not at the center. At the edges. A small bank. A credit fund restricting redemptions. A bond auction with thinner demand than expected. A deadline that expires. Stage 3 is when emergency lending caps get removed. When language shifts from resilient to closely monitoring. The crack is not the crisis. The crack is the announcement that the crisis has already been underway longer than anyone officially admitted. Stage 4 is the reset. Sometimes managed and orderly. Sometimes fast and catastrophic. But it always, in every historical example without exception, involves a large transfer of wealth from people who did not understand the system to people who did. From people who trusted the reassurances to people who read the edge cracks correctly. The question is never whether stage 4 happens. The question is only where you are standing when it does. Let me prove this blueprint is not theoretical. The year is 1929. Stage 1 ran across the entire decade of the 1920s. By 1929, investors were borrowing 90 cents on the dollar to speculate in stocks. $1 of real capital was supporting $10 of market exposure across millions of accounts on every major exchange. In February of 1929, 8 months before the crash, the Federal Reserve sent a private letter to member banks warning them directly to stop extending credit for speculative stock purchases. Private. Not published. Not available to the investing public. It did not surface until researchers uncovered it decades later. The people at the center of the system received a warning. The ordinary Americans whose savings were tied up in that market did not. They found out in October. Stage 2 was the vertical phase of the bull market. Between 1925 and 1929, the Dow Jones Industrial Average tripled. Stage 3 arrived in the final week of October. October 24th, 12.9 million shares traded, a record. October 29th, 16.4 million shares changed hands. The Dow fell 23% in 2 days. But here is what most people miss. The banks did not fail immediately. The crash was stage 3. The banking collapse, more than 9,000 American banks failing between 1930 and 1933, was stage 4. By the bottom, the market had surrendered 90% of its value from the 1929 peak. Stage 4 lasted a decade. The banks that had received the private February warning had already repositioned. They were not unharmed. But the severity of their losses was dramatically different from institutions that had no warning. The information existed. It simply was not distributed equally. Check. Verified. Undeniable. September 1998. Long-term capital management. A hedge fund run by 2 Nobel Prize-winning economists, a former Federal Reserve vice chairman, and the architects of modern quantitative bond trading. Underneath extraordinary returns sat a leverage ratio of more than 250 to 1. $1 of real investor capital supporting $250 of market exposure. When Russia defaulted on its government debt in August 1998, markets moved in ways LTCM's models said were impossible. Correlations that were supposed to provide safety collapsed simultaneously. The fund lost hundreds of millions per day. By September, the New York Fed concluded that an uncontrolled collapse would trigger a chain reaction nobody could contain. Every major bank CEO in New York got a Sunday phone call. Come in today or the system breaks. 14 banks participated in a $3.6 billion rescue. All of them had known the leverage ratios for years. They funded the fund anyway. Markets opened Monday as if nothing had happened. March 14th of 2008. A Friday. Bear Stearns. An 85-year-old institution. On Monday, approximately $18 billion in cash. By Friday morning, almost nothing accessible for settlement. Short-term creditors were not reducing their overnight funding. They were pulling it entirely. Over that Saturday and Sunday, the Treasury Secretary, the Fed Chairman, the President of the New York Fed, and the CEO of J.P. Morgan held the conversations that rewrote the rules of American finance. J.P. Morgan would acquire Bear Stearns. The Fed would provide a $30 billion loan backed by Bear's most troubled mortgage assets. The price paid to shareholders, $2 per share. The prior year those shares had traded above $170. The Fed invoked Section 13-3 of the Federal Reserve Act, a Depression-era emergency provision not used since the 1930s. The rules of American finance rewritten over a single weekend. Without a congressional vote. Without public debate. 6 months later, Lehman Brothers failed. $60 trillion in global wealth was destroyed in the following 18 months. Check. Verified. Undeniable. The pattern does not break. It only advances. Now let me show you how stage 3 of the current cycle is already documented. January 30th of 2026. Illinois regulators closed Metropolitan Capital Bank and Trust in Chicago. Assets of $260 million. Deposits of $212 million. Estimated cost to the Deposit Insurance Fund, $19.7 million. Regulators called it routine. Then February 19th of 2026. Blue Owl Capital, with over $300 billion in assets under management, announced it was restricting quarterly redemptions. Its technology-focused vehicle saw withdrawal requests jump to approximately 15% of net asset value in a single quarter. A 200% surge in redemptions. Blue Owl moved to liquidate approximately $1.4 billion in assets and returned only 30% of capital to investors within 45 days. 30 cents on the dollar. Not 100. Not 50. 30 cents. Economist Mohammed El-Arian publicly asked whether this was a canary in the coal mine, similar to August of 2007. Remember August of 2007? Two Bear Stearns hedge funds collapsed. Everyone said contained. 13 months later, Lehman Brothers filed for bankruptcy and the global financial system came within 48 hours of complete seizure. Now this week, April 6th of 2026. The IEA has officially characterized the Strait of Hormuz closure as the largest oil supply disruption in the history of the global oil market. Iran has made 21 confirmed attacks on merchant ships. Kuwait Petroleum Corporation announced yesterday that several of its operational facilities were attacked by Iranian drones with significant damage. OPEC Plus agreed on Sunday to increase production by 206,000 barrels per day in May, but acknowledged that repairing energy infrastructure damaged by Iranian attacks is both costly and takes a long time. Nobody knows how that oil reaches the market with the strait still closed. The S&P 500 has now posted 5 consecutive losing weeks. Goldman Sachs raised its 12-month recession probability to 30%. Parthenon sits at 40%. Wilmington Trust at 45%. The baseline in a normal 12-month window is 20%. Every major institution is running above the baseline. Stage 3 does not arrive with a press conference. It arrives at the edges. A small bank. A gated fund. A closed waterway. A rejected ceasefire. Let me be specific about the mechanism, because the financial implications only make sense when you understand what is physically happening. The Strait of Hormuz is 21 miles wide at its narrowest point. Through those 21 miles flows approximately 20 million barrels of oil per day, roughly 20% of all seaborne oil trade. The IEA has called the closure the largest oil supply disruption in history. The 1973 Arab oil embargo removed 5 million barrels per day. The 1979 Iranian Revolution disrupted 3.9 million barrels. The current disruption is larger than both of those combined. Gas prices crossed $4 per gallon nationally this week for the first time since 2022. In the Goldman worst-case scenario, a one-month disruption to the strait, Brent could spike to $110 with headline inflation reaching a spring peak near 4.5%. That scenario is no longer worst case. It is the current baseline. Oxford Economics has separately identified $140 per barrel as the threshold at which the global economy tips into mild recession, reducing world GDP by 0.7% by year-end and pushing the UK, the Eurozone, and Japan into contraction. The disruption does not stop at oil. The Strait region accounts for 30 to 35% of global urea exports and 20 to 30% of ammonia exports. These are the inputs for fertilizer. This crisis is hitting at the worst possible time, coinciding with the Northern Hemisphere's spring planting season. Fertilizer prices are projected to roughly double from 2024 levels. Agricultural analysts warn this will lower yields for wheat, rice, and maize. Qatar Energy declared force majeure on all liquefied natural gas exports when the strait closed. Europe gets 12 to 14% of its LNG from Qatar through the strait. European gas benchmarks have nearly doubled. The EU Energy Commissioner sent an emergency letter to ministers this week warning governments to prepare for a potentially prolonged disruption. UK inflation is expected to breach 5% in 2026. The OECD revised its 2026 US inflation forecast from 2.8% to 4.2%. The Federal Reserve's own March projection was 2.7%. Goldman raised its headline PCE inflation forecast to 2.9% by December and estimated that tariffs had already added more than 70 basis points to core inflation on top of the energy shock. The Federal Reserve is paralyzed. The last time America sat in this exact configuration was the 1970s. That era required rates above 20% and a decade of pain to reset. Now let me show you the layer underneath everything I just described. The oil shock is the visible crisis. What is underneath it has been building for years. Japan is the single largest foreign holder of United States debt, with $1.2 trillion in holdings as of November 2025. For 3 decades, that position was rational. The Bank of Japan held rates at or near zero. Japanese life insurers needed yield. American treasuries provided it. That structure broke in 2026. In December 2025, the Bank of Japan raised its short-term policy rate to 0.75%. By January 20th of 2026, Japan's 40-year government bond yield crossed 4% for the first time in over 3 decades. Specifically 4.24%. The 10-year yield hit 2.38%, its highest level since 1999. Japanese life insurance companies are sitting on estimated unrealized losses of approximately $60 billion on their domestic bond portfolios. When domestic yields rise, domestic bond values fall. When bond values fall, these institutions face capital constraints. When they face capital constraints, they sell the most liquid foreign assets they hold. United States Treasuries are their most liquid foreign asset. Japan's Securities Dealers Association data confirms that local insurers sold a record 822.4 billion yen, approximately $5.2 billion, of bonds with maturities over 10 years in a single month in December 2025. 1 month. A record. China's treasury holdings fell from approximately $1.3 trillion in 2013 to $683 billion by November 2025, the lowest since 2008. China simultaneously purchased 538 metric tons of gold over the decade. The People's Bank of China reported 14 consecutive months of gold reserve additions as of early 2026. The 30-year Treasury yield closed at 4.98% on March 27. J.P. Morgan noted that the simultaneous decline in American equities, the dollar, and treasuries occurred for only the 13th time since 1970 and had not happened at all since 1981. As of April 2026, the pattern has not resolved. It has paused and resumed. And now the number buried in the Federal Reserve's own audited financial statements. In January 2024, the Fed released its annual financial report. Buried in the footnotes, not the press release, not the chairman's speech, the actual footnotes of the audited balance sheet, was a deferred asset of approximately $173 billion. Deferred asset is accounting language for losses the institution has already incurred but has not yet formally recognized because it expects to earn them back in future years. The institution responsible for the financial stability of the United States economy was carrying $173 billion in unrecognized losses. For decades, the Fed remitted between $80 and $100 billion per year to the U.S. Treasury. That revenue stream went completely dark in late 2022. Not reduced. Gone. Every year the Fed covers its losses by not remitting profits to the Treasury. The government borrows more, the national debt grows faster. The Fed eventually buys more bonds to keep rates manageable, which produces more losses. That loop is currently spinning. The Fed ended quantitative tightening early because the system could not absorb further tightening. On December 31st of 2025, the New York Fed pumped $74.6 billion into the banking system in a single overnight loan, breaking the prior record of $50.35 billion set just 2 months earlier. They removed all caps on the standing repo facility. No ceiling. No daily limit. On December 12th, they began buying Treasury securities again at $40 billion per month under a name other than quantitative easing. Federal Reserve Governor Stephen Moran confirmed in a speech on March 26 of 2026 that future balance sheet reduction would require, in his own words, more frequent and regular use of Fed-provided liquidity. A sitting Federal Reserve governor publicly confirming the system now requires continuous emergency support to function. That is not reassurance. That is stage 3, confirmed in the words of the institution managing it. Let me be direct, because this is not a time for vague platitudes about staying the course. First, understand what tonight means. Trump's deadline expires at 8 p.m. Eastern. Iran rejected the ceasefire this morning. The April 28 FOMC meeting and Q1 GDP release are the next major data inputs. If the Moody's model crosses 50%, history says what follows within 12 months is not a question. It is a precedent. This is the highest risk window of 2026 and it is open right now. Second, protect your liquidity. If you do not have an emergency fund covering 6 to 12 months of essential expenses, building one is the immediate priority. Not in stocks. Not in bonds. In cash, in an FDIC-insured high-yield savings account. Top accounts are still paying 4 to 5% APY as of this week. Vero Money offering up to 5%. Axos Bank up to 4.21%. Newtek Bank up to 4.2%. Nationally available, FDIC-insured, no-fee accounts you can open online in minutes. On $50,000, the difference between 0.39%, the national average, and 4.2% is nearly $2,000 per year in additional earnings. If you have more than $250,000 at any single bank, spread it across multiple institutions immediately. Third, audit your concentration risk. The Nasdaq is down more than 12.5% from its record high. The average company inside it is down 31%. Goldman has pushed both expected rate cuts to September and December. Tech stocks priced for growth are the last place you want to be when rate cuts evaporate and oil sits above $100. Advisors at Morningstar and Morgan Stanley have both recommended increasing exposure to defense and security themes, where government spending creates multi-year demand regardless of the broader economic cycle. Fourth, consider the gold pullback. Gold is down approximately 17% from its January highs. That decline is driven by forced selling in a liquidity event, not by a change in the fundamental case. The case for a hard asset with no counterparty risk is stronger today than it has been in years. A 5 to 15% allocation provides insurance against exactly this scenario. The pullback has created an entry point that did not exist in January. Fifth, optimize your tax position. Converting a portion of a traditional IRA or 401k to a Roth now means paying tax on the current lower value. When the market recovers, all of that recovery grows tax-free inside the Roth. Consult a tax professional about your specific situation and bracket. The window is open now. It closes when prices recover. I am not telling you to panic. Panic has never been a strategy. Every historical example shows that the worst financial decisions are made in moments of fear, when people sell at the bottom because they cannot tolerate the uncertainty. I am telling you to prepare. And there is a critical difference between the two. Panic is reactive. Preparation is proactive. Panic means selling your holdings at a loss on Monday morning because the headlines scared you. Preparation means having already built your cash reserve, diversified your holdings, and structured your accounts so that a downturn becomes an opportunity rather than a catastrophe. The families that navigated 1929 with minimal damage understood what was happening before the center failed. The investors who protected themselves in 2008 were the ones who read the edge cracks correctly, years before the mainstream acknowledged the crisis. You now have the edge crack data. Metropolitan Capital Bank. Blue Owl. Gas prices crossing $4. OPEC plus pumping oil it cannot move through a closed strait. Iran rejecting the ceasefire today. Kuwait's oil facilities hit by drones yesterday. Nasdaq down 12.5%. Moody's at 49% before this week's news. February jobs revised to minus 133,000. The Fed having pumped $74.6 billion into the system on New Year's Eve. A Federal Reserve governor confirming in a March 2026 speech that the system now requires continuous emergency liquidity to function. The IEA has called this the largest oil supply disruption in history. Goldman says we are heading for a spring inflation peak near 4.5%. Oxford Economics says $140 oil tips the global economy into recession. And all of that data existed before tonight's deadline. Subscribe to this channel and turn on notifications. I will be back the moment there is a significant development tonight. The market opens Monday morning and it will price in whatever happens between now and then. Share this video with anyone who has money in the market, a retirement account, or simply pays for gasoline. Context is the difference between being positioned and being blindsided. And right now, context is everything.